On the Express this week, the Great Metal Meltdown. Debased to the face as all asset classes are getting smacked around to start off the week. Is a hawkish Fed circling overhead? BlackRock's Gargi Chaudhuri drops in with perspective on where to look for upside in these tricky times and why are investors selling like it's 1999. It's a Super Bowl of weeks. Say it with your chest. Let's play like champions on the Investopedia Express. Welcome back and welcome aboard, all Investopediacs out there, all Investopedia Express listeners and live watchers all over the world. We know you're out there. Always good to have you with us, get things started on a Monday. And what a busy week we have coming our way. We're going to get into all that later on in the show, but it feels like a helmet week out there. A lot of chaos out there. Hello, Hassam Seo. Hello to you. Good morning and welcome to the Investopedia Express. Good to have you with us. Love to hear from all our Investopedia listeners and watchers all over the world. We know you're tuned in, the smartest investors on the planet. Check in with the Investopedia Express. As I said, it feels like a helmet week. Asset prices, a little bit of a meltdown this morning following a big sell-off in gold and silver that really started at the end of last week and kind of bled into all asset classes going into this week. Stocks under some pressure this morning, especially the big AI and tech stocks. We'll get into that. Bitcoin under some serious pressure. That is down deep in a bear market and keeps on spinning lower. Oil prices lower this morning. Tensions with Iran apparently cooling. Oil prices down a good 5-6%. And the metals under pressure again to start the week after a monster rally in gold and silver prices. It's really been going on for the better part of a year plus, but accelerated in January. Those are starting to melt down, and it's starting to take, as I said, other asset classes with it. But we got to say bye-bye to January, the month that felt like a year. We got a ton of news and a ton of snow in just 31 days. We had the invasion of Venezuela. We had threats to take over Greenland. We had Davos. We had the DOJ's lawsuit against the Fed, the nomination of a new Fed chair, the face-ripping rallies in silver and gold that faded at the end of last week. More worries about the overspend by the AI superscalers. That's starting to be a factor in their stock prices right now, and a deep freeze across most of the country. And the stock market still ended the month higher of 1.4%. So the January effect in full effect. Hopefully for the rest of this year, we'll see stock market still expenses by most measures, especially price to sales. GMO, the smart chart there, most stocks still trading at over 10 times price to sales. So investors have a lot of faith riding in the fact that they can turn those sales into profits. And so far, they have, for the most part. We've seen some misses. Microsoft getting smashed last week after not hitting its estimates and giving a little dire forecast going forward there. But most stocks and most profit growth across the S&P 500, really good. But when you look at what's moving in the stock market, it is not the big AI players and the big tech players that have been the story stocks for the past year and a half, 2 years, right? Look at some of these big stocks that are way off of their highs. Oracle down more than 40%. CoreWeave down more than 40%. ARM Holdings, big chip maker out of Europe, down more than 30%. Broadcom, massive chip maker, had a huge rally in 2025, down more than 20% in the bear market. NVIDIA and Microsoft both down around more than 10%. So the leadership has changed. It's that sector rotation we've been talking about. And sector rotation, usually the lifeblood of a bull market, although there is some tremors out there right now. You got to look at the best performing stocks in January. It really tells the tale of A, how hard it is to be a stock picker, and B, where the momentum is and where that rotation is manifesting. And it's manifesting in defense stocks like Lockheed Martin, up more than 30% in the month of January. Bun Global SE, that's a energy stock that's up 20% in the month of January. Caterpillar, industrial stock, welcome back. That's a good sign if you're thinking about more industrial production and GDP growth through that type of investment. Honeywell, of course, a defense stock. And then Qatar Energy. You got energy, you got defense, and you got industrials leading the way. Again, usually a sign of healthiness in a bull market, especially when you have Dow theory in full effect. And we actually know what we thought we knew and got what we thought we would get from the Federal Reserve last week. The Fed choosing to hold interest rates right where they are. No surprise there. Nobody was expecting the Fed to cut rates, but everybody was a little bit more interested in what Fed Chair Powell had to say about his future and the future of Fed independence. Let's hear what he had to say about that.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Yeah, no comment from the Fed chair on his future and the future of Fed independence, but a lot of it is coming to a head. We know the DOJ lawsuit is out there against the Fed. We'll see if that goes forward. We know that the Supreme Court is hearing the case against Lisa Cook, the Fed governor who the Trump administration sued apparently for, or allegedly for defrauding on her second mortgage. So there's a lot that will be playing out. But investors, we're going to miss Powell in the media, but investors might not miss Powell going forward. Bespoke Investments with a fun chart here on the stock market performance after the FOMC press conference, after those Fed meetings. And guess what? Fed Chair Powell's record is the worst among all four Fed governors of the modern era, and that includes Janet Yellen, that includes Ben Bernanke, and that includes Alan Greenspan. So investors don't love how the market reacts after his press conferences. Can't really do much with that statistic, but talk about it at cocktail parties or on podcasts like this. But guess what? We're going to be getting a new Fed chair to throw into that index come May if Kevin Warsh is confirmed by the Senate. That's the president's pick that he announced last Friday via Truth Social. Kevin Warsh Fed. Kevin Warsh has been around the Fed. Let me give you a quick bio on him. He was a Federal Reserve governor from 2006 to 2011. He was in the middle of the great financial crisis, helping sort those problems out there with Ben Bernanke and other officials during the crisis. He was nominated by George W. Bush when he was 35, the youngest person ever to serve on the Fed's Board of Governors. He was a White House national on the White House National Economic Council from 2002 to 2006, special assistant to President George W. Bush for economic policy. So he's been around policy. He's been around the White House. He's definitely been around the Fed, and he's worked on Wall Street. Morgan Stanley from 1995 to 2002, executive director in the M&A department. So this guy knows how deals are done, and also spent some time in academia at Stanford's Hoover Institution and a lecturer at the Graduate School of Business. Obviously also on corporate boards like UPS and others, but he also worked with Stanley Druckenmiller's Duquesne Family Office hedge fund. So he knows private markets, he knows hedge funds, he knows how the Fed works. I listened to him on a panel at the Reagan National Economic Forum last year. Pretty savvy dude. He's got some opinions about Bitcoin too, and he thinks it's got a future. So that might have something to do with it. But his policies, and this is what we need to know as investors, hawkish on inflation, wants the Fed to have a smaller balance sheet, reducing the Fed's balance sheet. You know, the Fed, for the past 20 plus years, has been responding to crises by buying more and more assets, mortgage-backed securities and treasury bonds. And while that stabilizes financial markets, it does bloat its balance sheet. And when its balance sheet's big, you don't really have a good sense of how the economy is actually truly performing. And you get this propensity for inflation. It kicks money into the market and creates more inflation. Kevin Warsh, hawkish on inflation. He wants less asset purchases and a smaller safety net for capital markets. Maybe that's why we've seen a little choppiness in the stock market and in the heavy metals over the past few days. They are an inflation hedge. Do not forget that. And if Warsh, if confirmed, is tough on inflation and lowers interest rates aggressively as the president wants to keep them in check, those metals are going to get a lot lighter. Well, that's a lot to take in, and we're just 1 month into the year, which is presenting us with all kinds of questions and opportunities, namely where to invest when the winds are blowing in all kinds of directions, it seems, these days. That's where macro analysis and fundamentals kick in, because there are bigger trends at play, my friends, that will determine where markets are headed and which ones to watch. And for that, we're joined by Gargi Chaudhuri, the Chief Investment and Portfolio Strategist Americas at BlackRock. Gargi joins us on The Drop-In. Gargi, thanks so much for joining us. We're going to get to your 2026 outlook in a minute, but 1 month into the year, which seems like 6 months already, it's been so busy. Given all the news, any big surprises?
It's so wonderful to be here. Thank you for having me. We joke on our desk that it's January 49th. It just feels like this month has gone on forever. Any big surprises? I mean, actually, the big surprise has been, given how many headlines we've gotten through the course of January, whether that was geopolitical in nature, political appointments, whether it was just around earnings, how stable the market's been. Of course, there's been volatility, but if you look at certain corners of the market, if you look at, for example, 10-year yields in fixed income, it hasn't had massive reactions. And I think that's a good thing. Now, obviously, as we're chatting today, there are some pockets of commodity markets that are showing a little bit of volatility. Maybe if I had to pick one thing, the volatile nature in commodity markets took me by surprise in January 2026.
The aggressive rise in gold and silver, I mean, we've been watching it, obviously, not just really last year. This has been a multi-year trend, but in the past month, it's been super aggressive. You attribute that to what people are calling the debasement trade, investors wanting to hold hard assets, or what do you think that's all about?
Yeah, so maybe we divide up into, the different metals. Obviously, when you look at gold, there's a huge amount of demand coming through from buyers of ETFs that are buying products like IAU, but also a lot of central banks who are buying gold to diversify away from their reserves in US dollars. So that's a theme that we think is going to continue, diversified buyer base. And on top of that, it's exactly what you said, Caleb, with respect to a questioning what the geopolitical outcome might look like. And a good hedge, obviously, in that scenario can be gold. Questioning the future value or the future reliability of US dollar. And questioning whether gold can be a good hedge in that scenario. And obviously, we don't think gold is the best inflation hedge, but many investors also turn to gold as an inflation hedge. All of those are leading to or have led to some of this incredible run up in prices that we've seen over the last few years. We think the main reason that many investors, regardless of your age, should consider it as a portfolio allocation is because it has low correlations to many other things you might hold in your portfolio. And again, low correlations meaning if your stocks go up every single day, gold may not always do that, but over a longer period of time, if you look back over 1 year or 2 years, the correlations tend to be pretty low. So they're not moving in the same direction. It adds something a little different. Silver, on the other hand, which obviously I know you follow as well, wow, what a move, especially today. What a move the last couple of weeks in terms of both up and down. Obviously, this is a little bit of the demand from an AI perspective, from a solar perspective. It's also a commodity that's a little bit more, the run-up happens more with a outlook in terms of growth being a little bit more positive than perhaps many were expecting, which is our view. So there's a few different drivers of the silver trade. And I'd say the same for copper. The copper story is very much about the electrification of, the grid demand. So a few different stories, but I certainly think that this year and the last few years are showing us why you need to have a small allocation to commodities as a diversifying source in your portfolio.
Yeah, we'll get into your notion on diversifying your diversifiers in a minute. All right, let's get into your 2026 outlook. Your team did such a good job putting this together. You're talking about above trend growth. Growth, as we know, comes from spending by consumers who've kind of hung in there despite our worries, and also spending by businesses. You see that really continuing on, and what, if anything, could derail it?
Sure. So yes, you're right. Growth does come from, as I like to say, it comes from how many people you have, how hard they work, and then you break that down further into sort of your demographics, your productivity when you're looking for a longer period of time. And obviously, as you break down the numbers, to your point, it's about investment spending, it's about consumer spending. And if you look at each of these, as we've seen recently, productivity has been accelerating pretty meaningfully. Now, it's easy to quickly jump to AI as the solution for that, but I think there are many other reasons. It's not just AI, even though we're obviously going to see a lot of AI-related productivity in the months and quarters ahead. But I do think it's other things like supply chains getting better and faster and easier because there's been so much sort of focus on that. So productivity is one driver of growth, and that's accelerating. On the other hand, coming back to your question on consumer consumers, so far, it's been a low hire, low fire economy. Job growth isn't picking up meaningfully, but at the same time, unemployment rate has remained steady. So consumers are hanging in. They're feeling good about spending. If you look at the savings rate, that's dropping a little bit, but I think is often a good sign. If you're tapping into your savings, that means you feel good about your economic prospects. So that's still holding in pretty well. If you look at a lot of the retail sales and durable good type numbers, those are all still positive, solid. And then, of course, you have this massive driver, which is, of course, the investment spending that comes from AI. And that was a big part of the story in 2025. And we think that that's going to also be a part of the story in 2026. You add that together with the fact that if you remember this time last year, which is hard to do, but if we can think back to 2025, think about how much uncertainty we all had with respect to tariff and what will that do to prices and how can we possibly afford to buy a pair of shoes anymore. And now if we think about where we are sitting today, yes, those tariff news, it certainly has come in. We've experienced that. Markets had a very jolting reaction to it at first. But we are fading some of those tariff uncertainties. On top of that, there's more fiscal stimulus coming. So there is going to be tax refunds that come through that will help the consumer in the second half of the year. And then there's monetary policy. We do expect 2 rate cuts between the sort of third quarter and the final months of the year. So add all of that, it's a really good backdrop for risk-taking. And that's what we outline in investment directions.
Yeah. Well, let's talk about monetary policy. We're talking Friday afternoon. We did hear this morning that the president's nominee to be the next Fed chair is Kevin Warsh, who used to work for the Fed. We know he's been hawkish on inflation, but also critical of this Fed, but also friendlier to the administration. He advised Trump on both the campaigns. So what are you expecting now that we know that news, assuming he gets confirmed?
Right. So first of all, markets hate uncertainty, and it is just great to have a name and a name that we're very familiar with. Obviously, this was someone that served at the Fed from 2006 to 2011. It's very easy, especially now with AI, to go back and look at all of the transcripts, how he's, any kind of speech he's made to get a full understanding, no matter who you are, of what Warsh has talked about in the past. So I think familiarity is good. The immediate reaction, that's only been a couple of hours today as we're recording Friday afternoon, has been dollar strengthening, a little bit higher move in rates. The market's down a little bit. I think it's too hard to have massive takeaways from half a day, especially the last day of the month, where I don't know how much of the dynamics of the moves in the market today are related to this announcement versus month-end trading, so many other factors. But I think the bigger thing for markets should be the certainty around having a credible leader at the Fed, which is so important for all of us as market participants. You need an independent and central bank where a leader such as what Chair Powell was is well regarded, and I'm sure Kevin Warsh will also be that, especially since he's come from the institution. And frankly, if the market ever moves one way or the other, whichever way, dovish, hawkish, stocks up, bonds up, whatever the case may be, on just one piece of news, I often find that you probably should be fading that because the market's driven by so many, many things. And we learned that story, I think, many times in 2025.
Absolutely. The media is going to make it a causation story probably, and a lot of people will talk that narrative. But and I know your team knows, and it's well known that there's lots of things at play right now. And I think you're right about all of those things. Let's talk about the AI as the dominant theme. It's been the dominant theme for the past several years. This has been, 2025 was a big acceleration in that spend in terms of CapEx, but also in terms of stock market concentration. We've seen some of those names fade a little bit that carried the day, but do you still see it being the theme, and what are the risks there?
Sure. So we absolutely see that as one of the dominant themes for 2026 as well. We believe that it's a dominant theme, it should be a dominant theme, not just in your equity positioning, for those of us listening, and how you should think about what equities you buy, but recognizing that it's going to be a dominant theme when you think about what the global GDP of the world is going to be. There's going to be an impact of that CapEx spend that many of these AI hyperscalers are doing. So it it's a dominant theme in many ways, the macro, as well as, of course, we're in the midst of earnings season right now, and we're getting some of those large hyperscalers report the earnings. So we're going to continue to focus on it. Now, the question this year that is different a little bit from 2025 is, number one, that the markets are going to be a lot more, or are going to have a lot more scrutiny around the capitalization and the monetization of all of this CapEx spending. So it's not just about these massive spendings and there's no revenue associated with it. I think seeing a lot more dispersion within the AI theme, recognizing that AI is not a monolith, it's going to be really important. But number two, also recognizing that despite this year where, we're seeing earnings growth come from many parts of the economy, and we'll talk about that in just a second, I hope, AI is still the largest AI companies. We look at about 40 of them in the S&P 500. When you look at the earnings growth of those companies, they're meaningfully higher, to the tune of about 30% compared to about 3% for the non-AI part of the market. That is certainly going to drive performance. We saw that in 2025. We're going to see that in 2026. One other thing to add, the reason why we're quite bullish 2026 is AI is a great game in town, but it's not the only game in town. So we are already beginning to see that broadening out, and we think that broadening out will continue. AI will remain a theme, but it'll take some of its friends along with it for the journey. So we're talking a little bit about looking at the value parts of the market. Certainly have AI as a part of your portfolio. We talk about the actively managed BlackRock AI fund, BAI, as a key way to get that AI exposure, but also think about the value parts of the economy that we think will continue to outperform in a world where growth, as we said, is accelerating, where monetary policy is going to be easier by the end of this year, and where we think that earnings growth will support that broadening out theme to continue.
Emerging markets or markets outside the U.S., a lot of them outperformed the U.S. in 2025 pretty handily. And I know that you expect some sort of continuation of the theme, at least in terms of performance, maybe not outperformance. Why? And why should investors be thinking about that broader diversification outside the U.S. again in 2026, given a lot of the big macro themes that are going on?
Yeah, it's a great question. And, we do these client calls on a weekly basis, and we ask our clients, how are you feeling about markets and how are you positioning your portfolios? And the one thing that we hear from clients often is, number one, they're looking to move outside of the U.S. to international markets, emerging markets in particular. And number two, we analyze portfolios. My team and I, we analyze portfolios to see what clients hold in their portfolios. And what we often find is for U.S. clients that are based here, have a massive overweight to the U.S., therefore an underweight to the rest of the world, which has obviously worked brilliantly over the last decade, but did cause some consternations in 2025. So we're just saying that 2026 you might not have the same dollar weakening tailwinds that you did that obviously benefited EM and DM pretty significantly. We might not have that exact same dollar weakened tailwind, but we have other tailwinds, which are the best thing for EM is actually DM growth. We have that, check. Another great thing for EM is actually loosening monetary policy in DM. We have that, and EM also. And then the third thing I'd say is just in terms of a recognition that this is an underallocation. So the flows, the technicals are going to be important, and we're already beginning to see that. Obviously, with respect to as we continue, or if we continue to see a little bit of dollar stability or continuous sort of move lower in dollar, I think that will force a lot of clients to ask themselves, do I have enough international exposure? Another theme that we hear from clients a lot is they love the AI narrative. They believe in the AI narrative, but they already have it. So what they want is they want diversification within their AI theme. So they want AI, but they want diversification within AI. The best way to do that is actually move away from the US AI markets. And you may not necessarily think international markets or EM markets when you think AI, but think about China. Think about Korea, think about Taiwan, especially, that's where all the supplies are coming from. Look at, we talk about for EM, we're talking about our IEMG ETF, but also look at something like an AIA, which is just giving you sort of exposure to Asia specifically. So there are a lot of different ways to diversify your AI story. Stay in AI, but go outside the US. And I think more and more people are waking up to emerging markets as an AI story, AI theme.
All right, quick, let's do how you might build a really good, diversified, responsible portfolio. If you're 25 to 35, we have a lot of listeners out there that are kind of beginning and getting into their investing journey, but want to make sure that they're solidified at that age group. What would you recommend?
First of all, congratulations that you're on your investing journey. When I was 25, I wish I was better about it. So congratulations. Number two, I'd say build a portfolio of stocks that, yes, all the big names that you're hearing of all the time, but make sure you're diversified. So have an ETF that gives you exposures to the themes you love, like AI or solar, but also you have some non-US exposure. You have some cyclicality as well as the tech theme. Because what I hear from, especially, the younger cohort of investors is, I've got 2 stocks and I've got, those are the 2 stocks that I love. And I get it. That's, very cool, but it might not be the most diversified way to approach the market, especially in volatile times. So definitely US tech is our favorite, US AI specifically, but look at value as well. And at the same time, emerging markets is one of the biggest ways to diversify outside and yet stay in the AI theme in Asia in particular. Now, you don't need too many bonds right now in your portfolio if you are about 25 years old, but at the same time, you might want other things like Bitcoin. IBIT is the ticker, which is for the ETP that we have. And again, something that's a little bit of adding something different in your portfolio. Same with gold, a little bit of something different in your portfolio. And finally, I'd say also if you're able to add what we call liquid alternatives. These are sort of macro funds that you can have access to that don't necessarily go in the same direction as the stock market. So you don't get what we call market beta. You might be market neutral, but still get some upside. So again, have a lot of equities, but make sure that you're diversified geographically. Have the AI theme, but right now we love the cyclical story. And then have a few other of these diversifiers. And we talked a little bit about Bitcoin, talked a little bit about gold, talked a little bit about liquid alts.
Yeah, and for those older investors, 45 to 55, or those nearing retirement or in there, it's about income preservation, but also diversifying your diversifiers. I know you talk about that in the note,
so we're not
show notes.
We're not going to call 45 older. We are not.
More mature investors,
We're
I
going
should
to
say.
investors that have been on this journey longer.
Sitting on gains if they've been invested for a while because they've been long the U.S. stock market.
So not older, but just in the market for
seasoned.
longer. What seasoned, experienced. I'd say that if you're closer to sort of your retirement age, one thing that's coming up a lot in conversations is that, you're not getting the same level of income that you were because rates have moved lower and they're going to move even further lower. So many of those sort of more seasoned investors have some cash in their portfolio that was earning, over 5% not 18 months ago. You're not going to get that. So seeking a multi-asset source of income in your portfolio. So really think this is where fixed income, especially now when you still have income, when you have a sizable amount of income in fixed income because rates, could move lower. They're sort of stable here at the 4.25 level, but sort of getting income from emerging markets, securitized assets, credit, and private and public credit, and building sort of 6 to 7% yielding portfolios when you still have the opportunity to do so. So that's number one. I'd say looking at dividends as a source of income as well, because that's obviously if you're allocating to a company that's paying dividends, it's also a good sort of AI hedge. They haven't spent a lot of cash in CapEx. And then the last thing I'd say is equity income. There's a lot of selling options and still garnering income, generating income while not giving up the growth. So we talk about BINC, which is our BlackRock Income Fund, as one source for fixed income. We talk about HDV, which is the dividend income. And then lastly, we think of something like Bali, which is that equity income source. So combine all of that as a source of income in your portfolio without giving up on growth. Because obviously, if you're young, 45, you still want that
Still got a lot.
growth in your portfolio. Yeah.
Hey, if you're 55, you want that growth in your portfolio.
You want the
too.
growth
So,
as well. There you go.
yeah, you always do. All right, we know you're a super athlete, a triathlete, a runner, a long distance runner, a marathoner, but you're also a market nerd like us here at Investopedia and all of our listeners and viewers out there. So we got to know, what is your favorite sort of market indicator, fundamental or macro, or one of your favorite things that just helps you sort of get that great snapshot of the market or the economy?
Yeah, I love this question. So I grew up in the tips market when it was at its infancy. So I have
Treasury,
to say
inflation,
CPI.
protected securities. folks.
Treasury,
Tip.
inflation, protected security. That's how I grew up in that business. That was my first job almost out of college. So CPI is a religious holiday for me. It's just a beautiful day. I love everything about the CPI report. It tells you so much about the economy, but it's also something that you can see in the data and draw parallel to your life, which I love. So you can see egg prices and you can actually be like, oh yeah, I experienced this in my real life. So that's one, CPI. And then the other thing I would say is the JOLTS data. So that's the job opening and labor turnover survey. Within that, there's a specific data point called the quits rate, which shows you how many people in the economy are quitting. And that gives you a good indication of what wages might look like. Obviously, if more people are quitting, they feel that they're able to find a job, rotate into a job, maybe for higher wages. So a lot of forward-looking indicators within that JOLTS data. So I love that one as well.
Yeah, well, we love the quits rate too, and JOLTS. That is also a holiday for us and all of our readers. We all pour in back into that term to look for it. I love that you love that one too. Thanks so much for sharing your insights with us. Gargi Chaudhuri, the Chief Investment and Portfolio Strategist, Americas at BlackRock. Thanks so much for joining the Express. Good to have you here.
It was great to be here. Thank you, Caleb.
Great stuff from Gargi and her team. We'll link to their 2026 outlook in the show notes. And check out, there's an ETF for everything out there. Definitely BlackRock iShares has plenty of those. Check those out as well. Let's get to a little money in motion. Just in that little time we were having that conversation with Gargi, a little turnaround in the markets, but we got to focus on money in motion. Money coming back a little bit to the gold and silver markets after a massive sell-off last week, especially silver. One of the biggest crashes for silver, I think, in history, down 28% in one day. Total meltdown of the precious metals. And why all of a sudden did that happen after a massive rally? Good chart there from Chartboy Matt, our guy at Ritholtz Wealth Management there. Worst day ever for silver. And silver's had some bad days. It's super volatile, much more volatile than gold. Considered a little cousin to gold, though I take that personally. That said, it's traded a lot more quickly than gold. People tend to hold gold a lot longer. Silver moves a little bit quicker than other asset prices. But why did that happen all of a sudden after such a massive run-up? Well, why did the run-up happen in the first place? Well, you got to take it back to what we call the debasement trade. Everyone's been talking about the debasement trade. Now, what is the debasement trade? Well, according to the world's greatest website in the world, Investopedia, it's an investment strategy defined by the systematic movement of capital out of assets denominated by sovereign promises, such as fiat currencies and traditional fixed income securities, read dollars and U.S. treasuries, and into assets characterized by verifiable, finite supply, often referred to as hard assets. That sounds like gold and silver to me. So that's where the money's been flowing. Even as the market has been making record highs and you've had this sort of melt up in a lot of parts of the stock market, there's a whole contingency of investors and central banks and institutional investors and hedge funds and everyone else that's saying, I don't know if I believe in this and I want to hold on to precious metals like gold. A little more secure there, especially with the dollar declining. The dollar, as we know, down over 11 or 12% in just the past year, and it's going to be headed lower. This administration wants a lower dollar. Lower dollars are good for companies that export outside the United States, and half of the companies in the S&P 500 get half of their revenue outside of the U.S. So they're going to keep pushing the dollar down. And you know where that happens a lot of those companies, industrial manufacturers, companies that make parts and ship them out to overseas, a lot of them are in Rust Belt states that are also swing states in the election. So there is no coincidence that we have a lower dollar. Just know the fact that it's going to be there. The fact is, when you see these asset prices like gold and silver swing so wildly, like they did last Thursday or Friday, and then come back a little bit this morning, you got to ask yourself, what is going on out there? And maybe it's a reaction, partially, because as Gargi reminds us, it's never just one thing, but maybe it's a reaction to the president's pick to succeed Jay Powell in the Fed in the form of Kevin Warsh, who is an inflation hawk, and he will reduce the balance sheet and he will fight inflation by lowering interest rates, and that's never good, as I said, for precious metals. So let's keep an eye on the debasement trade. I have a feeling we're going to see that as one of our terms of the year in 2026 from our great readers at Investopedia. All right, busy week heading into the Super Bowl. It is the Super Bowl of weeks in earnings season 2. Let's take a look at what's coming down the tracks. We'll say goodbye to January, my friends. That month lasted a year. But the question is, are we going to see the January effect in full effect? When January is higher, and our buddy Ryan Dietrich at the Carson Group likes to remind us of this, most of the time the stock market ends the year higher, and the stock market was up 1.4% in the month of January. So you see a good chart there by our buddies at Carson Research, Sonu and Ryan Dietrich putting that out there. Positive January is a good thing for 2026. And if you heard what Gargi and I were talking about too, well, the winds are in the sails of the equity market, maybe not in the usual places. All right, busy week ahead. All right, things get started today already. Earnings out this morning from Disney. Some upside surprise there, but we will also get some manufacturing numbers, the ISM manufacturing PMI index, earnings from Palantir later in the day, as well as from Mizuno Financial, among others tomorrow. Gargi's favorite term, JOLTS, the Job Openings and Labor Turnover Survey. That's tomorrow for the month of December. We're going to check the quits rate because we know it's important. How many people felt confident enough to get up and leave their jobs? Big earnings day on Tuesday, AMD, Merck, Amgen, Pfizer, and PepsiCo, among others. Wednesday, the ADP employment report. That's that private sector report. Remember, we had Nella Richardson on a few weeks ago. The private sector and the ADP's tracking of it, much more focused look at what's happening inside the jobs market today. And Fed Governor Lisa Cook on the speaking circuit. Why is that important? We don't pay attention to every Fed governor on the circuit, but she, as we know, is under a big case being evaluated by the Supreme Court, whether the president can fire her for allegedly defrauding on her second mortgage. That is a big shot at the Fed's independence. That's why it's getting all this attention. ISM Services PMI for January. Earnings on Wednesday from Google, Eli Lilly, AbbVie, Novartis, Uber, Qualcomm. Massive day of earnings. Thursday, initial jobless claims for the last week, and earnings from Amazon, Philip Morris, Shell, Bank of New York, Mellon, BMY coming out. No, that already came out. And Chevron, of course. And on Friday, the jobs report for the month of January. Getting back on schedule with our jobs reports finally. The jobs report for the month of January going to be pivotal. We know hiring's been slow. We'll see if the unemployment rate is stable at 4.4%. We'll get a read on consumer sentiment, the preliminary read for February. It's been sour. Consumer credit and earnings from Toyota. So a ton going on, which leads us into our indicator for the week at Investopedia. A ton to focus on, but right now, it's insider selling of stocks that's got our attention. That seems to be ramping up quite a bit. And why do we need to worry when insiders are selling their stock? Well, they know what's going on inside their companies. So why are they selling? We're taking a peek at a good chart here from the Washington Service. They monitor insider buys and sells, always do a great job with that. And the ratio of insiders selling stock versus those that are buying stock, that's nearing a multi-year high. It hasn't been this high since 2021 when things started skewing astray, and almost as high as it was back in 1999 before that internet bubble burst. Now, I'm not saying we're on the verge of a big stock market bubble bursting, but what insiders are selling, you got to ask yourself what's going on. Now, they sell for all kinds of reasons, right? They take money off the table to start the year. Maybe they didn't want to sell stock at the end of last year, get that extra income for the tax hit. So maybe they're starting the year with it. They got bills to pay. They got tuition to pay like the rest of us. Maybe they fear overvaluation. Maybe they feel like their stock's done pretty well and they want to take some off the table, diversify. Completely reasonable. Maybe they know something we don't know. That's not insider selling or insider trading, but maybe, things feel a little bit uneasy there, or maybe they're just human beings like the rest of us and don't want to have too much risk on the table. You don't want to too much invested in the company you're working for. You give them a lot of your time and energy anyway. Palantir earnings, beat or miss? Well, good question, Denari. Usually these companies beat on their earnings. It's usually the forecast that gets investors tied up in a knot. So I expect all these companies to meet their forecast because they know how the game is played and they know how to massage their earnings a little bit to make sure that they pop. But it's the forecast that we want to pay attention to. So hey, thanks for reaching out. Thanks for tuning into the Investopedia Express on Instagram. Bithan Joseph from India with love, learning long. Thank you. Stay long. The stock market, keep investing. Tuning in from Kuwait. Right on, Alan's. Nice to have you with us on the show. Jacques is there. Looks like is that New Zealand? I can't tell, but thanks for checking in, Zybrands. Thanks for checking in with us on the Investopedia Express live and direct here every Monday and then on demand on your favorite podcast networks. Busy week, my friends, heading in to the big game this Sunday. Stay healthy, stay warm, stay kind, and stay safe. And we will talk to you a little further on down the line.